Yes, there is a crystal ball for mortgage rates, and it's a lot more accurate than you might think. Let me walk you through the numbers and what the historical data tells us about what is about to happen with mortgage rates. And the first myth that we should dispel is that mortgage rates are based upon the Fed funds rate. So recently we saw the Federal Reserve cut the Fed funds rate by 0.5%. And immediately thereafter, over the next 30 days, we've seen mortgage rates increase by about 0.7%. So what gives? And is there a more accurate crystal ball so that we can predict what's likely to happen to mortgage rates? And the answer is yes. We simply need to look back at history. So let me walk you through our most recent blog post and some graphics here that we created to help you understand the historical context of mortgage rates, and more importantly, their relationship with the 10-year US Treasury bond. There is a direct correlation, a direct link, if you will, between the 10-year US Treasury bill, what's called the yield of the 10-year Treasury bill, and mortgage rates. In fact, there's always a margin between the 10-year Treasury bill and mortgages. So when the yield or the rate goes up on the 10-year Treasury bond, mortgage rates will rise in somewhat lockstep with it. So mortgage rates are correlated to the Treasury bill, not to the Federal Reserve set Fed funds rate. So let's look back on how that works in history. And what we're going to see is that after the initial Fed funds rate cut, it is normal. In fact, it happened in almost every instance going back to 1984, that immediately after the Fed cuts the Fed funds rate, that the yield on the 10-year Treasury goes up. And when the yield or rate on the 10-year Treasury goes up, so do mortgage rates. But what's important about this historical context is that it goes up immediately following the Fed rate cut, but then the yield on the 10-year Treasury goes down, and that means mortgage rates go down. So let's look at these historical cycles going back over the last 40 years. In 1984, we can see that the Fed cut the Fed funds rate by 0.25%. And remember, team, the Fed funds rate is an overnight interbank lending rate. It's a 24-hour rate. So it makes sense, once you understand what that rate is, that it wouldn't have a direct impact on a 30-year fixed mortgage. So at 1984, the Fed cut 0.25%. And at that time, the yield or the rate on the 10-year Treasury was 12.25%. What we immediately saw after the Fed rate cut was a spike in the 10-year yield, 0.31% higher, and the post-cut cycle high was 12.56, meaning after the Fed cut the Fed funds rate, the yield went up 0.31%. And we can see that's fairly consistent going back over the last 40 years. 1987, Fed drops 0.5%. There's a spike in the 10-year going up 0.37%. In 1989, the Fed cuts a quarter. The yield on the 10-year Treasury goes up. In 1995, the Fed cuts a quarter. The yield on the 10-year Treasury goes up 0.41%. 2001, the Fed cuts 0.5% or 50 basis points. And immediately thereafter, the yield on the Treasury goes up. And you can see this is a fairly consistent reaction. But here's what's really important as it relates to having a crystal ball and clear insights as to where mortgage rates are going. What happens after the initial reaction of the 10-year Treasury going up, and remember, there's a direct correlation between the 10-year Treasury and mortgage rates, is that then the 10-year Treasury and mortgage rates go down. So you'll see what will happen is, if we look at, this is the post-cut cycle the highest rate after the Fed cut in that cycle. But then look what happens thereafter as the 10-year Treasury rates go down. So this is the cycle high after the Fed cuts. This is the cycle low. So that means it spiked to 12.56% and then dropped to 6.95%, which means that the yield on the 10-year Treasury, the other word for yield is rate, the rate on the 10-year Treasury dropped 5.3% from 12.25 to 6.95. And we see this consistently. We saw a 5.3% drop in 1984, 0.8% drop in 1987, a 3.17% drop in 1989, so on and so forth. In fact, if we average all of these drops in the 10-year Treasury over the last 40 years, we get an average of a 37% decrease or drop in rate on the 10-year Treasury. And if we apply that historical average of 37% to where the 10-year yield was when the Federal Reserve cut rates, we can get some insight as to where mortgage rates will go. So let me just go down this blog a little further here so I can get you a few more pieces of information. So yes, as we average those declines in the 10-year yields, a 37% decline is typical. Now, we know that as of the date of the cut, the 10-year Treasury yield was 4.06%. And if we apply a 37% drop, which is typical, we could expect the 10-year Treasury in this cycle to drop to 2.35%. Now, that's very important because there is a margin between the 10-year Treasury yield and 30-year fixed mortgage rates, which is about 2.5%. So if we know that the Treasury yields historically go down 37%, and that's going to put the 10-year Treasury at 2.35, and then we apply the historical margin between the 10-year Treasury and 30-year fixed mortgage rates, that means that we could see mortgage rates as low as 4.8% in this cycle. So what's the moral of the story, team? The moral of the story is it is typical, normal, status quo for us to see an immediate spike in the 10-year Treasury and therefore mortgage rates after the initial Fed cut. And if we apply historical context going back over the last 40 years to 1984, we could anticipate that we will see mortgage rates as low as 4.8%. Now, here is the really important information that you need to know. What do you think's going to happen to the real estate market when mortgage rates get to 4.8%? Well, of course, demand is going to go up because affordability is going to go up. And that is going to bring millions of millennials and Gen Zers that are currently sitting on the sidelines into the housing market. So the ninja move here is to apply the historical lessons of dropping mortgage rates after the Fed rate cut and to beat those millions of buyers to the market. Buy now before the demand comes back to the housing market. And as those rates drop into the future, you can refinance your mortgage indebtedness to the lower level. But if you wait to buy and you have those millions of buyers that you're competing with, you will find yourselves in a multiple offer situation. You'll find yourself in a situation where the seller feels very confident because there's 50 people going through their open house. Right now, we see a slowdown in the real estate market. Sellers are not confident. In fact, sellers hate this market. When rates are going up, sellers hate this market because there's not as many buyers coming through their homes. You want to buy when the sellers are not feeling confident, when the sellers are willing to give you concessions to buy down your mortgage rate, when the seller's willing to negotiate on the sales price, when the seller is willing to give you a concession to pay your closing costs. If you wait for rates to go down, the seller regains all the power. I hope this was very valuable and insightful for you. If you found it valuable, please follow our YouTube channel for more valuable insights like this.